Good afternoon, everyone, and thank you so much for being here in person, which is actually not trivial considering the level of uncertainty around all of us. But then, if it's true that fortune favors the bold, I guess we're all heading towards a very successful 2022. At the same time, it's probably difficult to blame all the people and their concerns about the current situation. We're all experiencing, again, a level of uncertainty that we probably have seen already happening in the previous 20 months. And I guess, ladies and gentlemen, let me refresh your memory. I mean, we are actually, we've gone through a period of fairly high uncertainty. Actually, something like 1 in 300 years event. So something really incredible. And I guess we've all experienced that. This has been one of the worst GDP decline in the recent financial history. The picture you see there is the UK, but it's not different from many other countries in Europe. And to find a year with a worse GDP decline, you actually need to go back more than 300 years. It's quite incredible. Obviously, the next question you may have, if this is true, then why are we not experiencing something like the Great Famine? Like, I would think that our living standards by now should be completely different from what they were pre-pandemic. The reality is that obviously the level of government support that has been put in place has been unprecedented. A mix of equity, debt, guarantees that have been extended to a lot of businesses across Europe and in general across the world. What was the idea? The basic idea was to try to help businesses to navigate the uncertainty, to move from the start of the pandemic towards, well, a certain point, hopefully as soon as possible, when that pandemic is finished. We all felt that we almost reached that point, and so the level of government support has slowly been declining in the most recent months. But there are three main impacts that we have observed at Wiserfunding, and one very important. First of all, the decline in correlation between GDP and unemployment rate, almost 60%. That's very important. That's why we are seeing unemployment rates probably very low across all Europe, just because due to the level of government support, the unemployment has not gone up as you would expect during a crisis. So this is great. I mean, a lot of people kept their job. And obviously that helped the market to continue. The second, very important, I guess, is the level of disposable income. Well, this is very counterintuitive, I would say. During a crisis, you would expect the level of disposable income to reduce, but on average, that actually increased 20 times. Well, why? I don't need to explain to you. I'm sure you all know. We couldn't go to a restaurant, we couldn't go to a holiday or nice places that we enjoy. Obviously, so people couldn't spend and saved more. And that probably explains to you also why we saw a lot of different asset classes appreciating. I mean, stock markets going up, crypto going up, and house prices going up. That's because this disposable income. People saving, they had to put it somewhere. Some people kept it on the saving account, some others invested that money in stocks, crypto, houses, whatever. That's what I generally call like a big pile of cash that at some point, it's a good question, when will go back into the system. So we will need to see what's really going to happen, how people are going to distribute that additional savings that have managed to put aside during the lockdown. And the third, probably more relevant for today, I mean, this is a beautiful graph. look at these three lines. The yellow lines represent basically the level of default, insolvency, bankruptcies across Europe, generally in all previous crises. The blue one is actually the level of default during the last 2008-2009 crisis, so the great financial crisis. The orange, I don't know if you know, but this is called now the Great Lockdown. That's the way the IMF has defined the latest period. And well, I guess you can all see that line went down 30 to 40% across most countries in Europe. That's absolutely incredible, right? I mean, I've been here in the last 2 days. I've heard a lot of people saying, well, we're not experiencing the level of defaults that we would generally experience through a crisis. Well, that's it, right? You're seeing that. And that is due, again, mainly to the government support that has helped companies to navigate this period. But many of these companies have been kept alive just on life support, I would say. So companies that on average would have defaulted, haven't defaulted, mainly because they've been helped, they've been kept alive artificially. And actually, this is what the co-founder of Wiserfunding, Professor Altman, calls the zombies, zombie companies. So companies that in reality, I mean, would have gone already, would have defaulted, but they're still around there. And they're very dangerous. They're dangerous because obviously their business model hasn't really adapted to the new reality, to the new normal, we call it. And obviously this is something dangerous for lenders, for investors. Being able to identify zombies is going to be a critical element in the new coming months. So you see also that line there. This is again the UK. You see that the line started to go up about 3 months ago. So the level of insolvencies is now going back towards the historic average. But the real question is it going to stop at the historic average or is going to continue? So these are all the uncertainties that we are currently facing. And that's pretty much what we are helping our clients with at Wiserfunding. So we created a tool that basically sits right in the middle between the credit reference agencies and the rating agencies to help our clients to assess the quality of SMEs. And to do that, we basically use a lot of different tools. We've grown very quickly in the last 5 years, also thanks to the uncertainty, obviously. We now have more than 70 clients across multiple countries and also very large banks that we support to identify the most resilient SMEs, the one that can adapt and move forward into the new post-pandemic era. I'm actually quite happy to say, I'll show you a use case later, but also thanks to our tool, in 2021, our clients have lent more than 3 billion to SMEs. And that's so important. SMEs need, now probably more than ever, the support of our industry. There is no doubt. So this is really important to us. How we do it? I mean, it's basically a cloud-based solution. So what we do, and probably many of you have something similar, but what we have created is a cloud-based solution that is connected to multiple APIs that help us to retrieve a very large amount of data. We're talking of more than 800 data points per company, and that's in few seconds. All this massive amount of data points goes into the back end where they get processed, and then we retrieve the output, the insights that we provide to our clients. That's the way this works. And we've been able to develop a very large amount of models segmented by country and industry sector, because I'm sure, here you're all experts, so I don't need to tell you that the more you segment, the more homogeneous pools you can create, the better will be your prediction accuracy. The way the models are structured is very similar. You have basically 3 modules. looking at the financial history, looking at anything that is non-financial, very important, especially for SMEs, understanding what are the elements, non-financial elements that we retrieve from the web, public sources most of the times, and then macroeconomics. So I heard before a lot of discussion about how to integrate the new impact of COVID. Well, for us was always trying to correct the models on the go. So really macroeconomics correcting the relationship between the score and the probability of default that we calculate. And that's the way we do it. Otherwise, obviously, the next question is, should I use 2020? What's going to happen there? I don't have enough defaults. I mean, all the questions that we were discussed in the previous session. So this is basically the structure of the models and the variables that we retrieve. The most important metrics, basically you have a probability of default, loss given default, a score, and a bond rating equivalent. And I want to stop there for a second because SMEs in the past, I mean, they've never been assigned a rating. I mean, it's generally quite expensive. So the way we do that is mapping our score to the Standard & Poor's rating scale. It's almost trying to compare an SME to a large corporate. This helps quite a lot because obviously any score, as well as any PD or LGD, generally tend to be an internal language. So it's known to you what 300, 400, 500 means, but not to the outside world. So for you to be able to speak to investors, to clients, obviously having a well-known worldwide spread language of credit like a rating obviously helps quite a lot. And that's very helpful also for SMEs, for them to understand where they stand compared to the outside world. All this is a company level, but at the end, what I think many of us are starting to consider at this point is the portfolio view. Early warnings. If we want to identify zombies, we need to be able to classify them correctly and observe our portfolio and how this is performing. So creating watch lists that can help us to take the right actions at the right time. This is something we've been doing quite a lot lately with our clients, just because taking the right decision at the right time is absolutely fundamental right now. You see the level of uncertainty, you see how things are changing quickly. And zombies come up almost on a daily basis because of the continuous changes of the business model. So it's critical to control the entry point, the acquisition, as well as the monitoring of the portfolio. That's absolutely critical. And on that, let me move to the use case. I think this is quite important. I'm taking a case of a medium European bank. They basically have been using their own internal models, and towards the end of 2020 got in touch with us, and they told us, well, can we just backtest your models, understand how you can help us to potentially segment further what we see in our portfolio. So the first thing we did was to generate, obviously, the typical score and PD curves. You see here the score, fairly good. I mean, the yellow line is actually the base case, and the orange was a stress. We actually ran 2 or 3 different stress testing for them, but this is just one of them. And the idea was, again, one of the way we identified zombies is trying to see under stress how many of them have a chance to survive. And it's not just their risk profile, it's also their business model. So there is a very strong correlation between what they want to do and how they are prepared to do in their specific industry sector. So once these curves were created, we basically had all the inputs we needed. This is the PD here. And where I'm going is the next slide. So this, sorry, a little bit, a lot of numbers, a lot of colors, but let me try to explain this slide here. So basically what we did on the top is their internal scoring model that has got 10 classes. And on the left side, so the y-axis, you basically see our own internal classification, so what we call bond rating equivalent. So obviously, you see that for each one of their rating classes, obviously 1 is best, 10 is worst. And for each one of their rating classes, we were able to segment a lot and create different clusters. That's okay. I mean, overall, probably the message wasn't too different. But there were the red ones, the bottom ones. Why they are red? These, in our opinion, we're talking about January, February 21, were kind of the potential zombie companies, the one that we had identified as at risk. And obviously, you can see that many of them were classified pretty good risk profile with the internal models of the bank. We were talking about 179 companies, so approximately 8% of the portfolio. No one knew anything else at that point, okay? So the idea was, well, let's just wait and see what happens in the next few months. Obviously, it was kind of a forward-looking back testing, really, rather than a backward-looking one. The only way to do this is to look forward, because the reality is, because of the uncertainty, if you look backwards, you won't be able to backtest what we do. And after about 10 months, well, the default rates in the red area is almost 9 times higher than in the same classes above, so in the yellow one, for each one of their internal rating. So this was a great finding. These were exactly the type of companies that could create an internal problem to the bank, the one that were at risk. And actually, you know, they were offered some sort of forbearance. I mean, you know, the typical ways, obviously, when they got into troubles. But what we identified was exactly that lack of resilience. They weren't able to survive. They had survived only because of the government support, only because, obviously, everything that had been offered to them was a short-term solution, but they didn't have the long-term one. So very important finding. So to close, I guess, in this moment, it is fundamental to support SMEs. And all lenders during 2020 have done a fantastic job to support SMEs, but a lot of that has been also driven by the level of government support, the guarantees that were offered. So obviously now that that level of support is disappearing, it is important that the financial industry doesn't just leave SMEs on their own. So being able to assess their quality and identify the right ones, identify where to allocate funds, remains a key element of this selection and will improve the efficiency of the entire market. So thank you very much for your attention. I'm happy to take any question.
So do we have questions for Gabriele? I might have one, actually, just to start with a little bit. So, as you mentioned, so you cover quite a lot of countries. Which countries are you effectively deploying your model so far?
Sure. I mean, mainly across all Europe. So Europe is fully covered, and basically that's our main market where most of our clients are. But we're starting to have clients also in Asia and North America.
And what about the quality of the data? Okay,
Yeah,
But,
well, obviously,
pretty
yeah.
disparate.
Absolutely. I mean, across Europe, you've got a lot of data. I mean, we all know there is like ability now to access data from, open banking, accounting data, public data about financials, any sort of qualitative information, social media, news. It's all readily available in Europe. When you move outside of Europe, financial data start to become less available, and then on the qualitative side, it really depends country by country. I mean, for example, in India, you still have quite a lot of news, but the social media aspect is less relevant, different in Asia or in the US. So it really depends country by country.
Do we have more questions for Gabriele? Because I have at least a couple. So you mentioned, so you definitely go into the alternative data realm in your modeling here. And what's kind of the share, the proportion of alternative new types of data versus traditional data sets?
But traditional is still the most important. I mean, about 60%, explain about 60% of our output, the traditional part. The non-traditional, let's call it alternative data, it's about 40%, but the big uncertainty every time you look at especially an SME, you never know what you can find out there. So the moment the API goes out and try to retrieve alternative data, you may find 60% of them are missing. So basically, the weights of our different modules adapt based on the number of missing information we find in the market.
Still no question? Okay, I have a last one. So your models, if they are used for credit decision-making purposes, I suppose that they need to go through some level of independent review.
Yeah.
And how do you deal with that? Are you really opening the whole model, including the code, or how does that work exactly?
Yeah, sure. I mean, no, very good question. I mean, we've gone with different regulators through validation, what they call validation. So it's generally a validation limited to basically the input and the outputs of the models and a back testing of those. So that's the level of, then obviously internal auditors, external auditors. I mean, there are all different type of reviews there, also depending on the use. It could be sometimes IFRS 9, so more a finance related rather than a risk related. But yeah, generally, I mean, we support our clients in this review and we provide all the information that is required.
Thank you.
So I have a question. So is your ranking agnostic of macroeconomic conditions, and do you have a time frame for default?
Sorry, can you repeat? Do I have a what?
So the first question is your ranking agnostic of macroeconomic conditions? And the second, whether your projections, what's the time frame in terms of default?
Yeah, thank you. Well, no, it's not agnostic, and that's the reason why we have a specific macroeconomic module that will adapt on a monthly basis. So generally, we take the current macroeconomic conditions into account, but obviously if we are running a stress testing, a scenario analysis, we can also feed the models with forward-looking macroeconomic expectations. In terms of the default is generally 12 months. So our probability of default is a 12 months probability of default. That's generally our horizon. With some of our clients where we support them on an IFRS 9 side, then obviously we help them to derive also a lifetime PD, so up to 10 years.
Okay, we have a question here in the front as well.
No.
Let me reformulate. For existing clients or for new clients only? That was your question.
Yeah.
That's the question.
Thank you. Yeah, actually both. Most of the time, the most common use case would be new clients. So the origination the efficiency of the origination is probably one of the most common use cases for our tool. The portfolio, the monitoring, is definitely important given the type of data we use. Then it's good because you can refresh on a monthly, on a quarterly basis. But I would say the probably most common use case for us is acquisition.
Okay, do we have more questions? Yes?
You already are in many countries in different parts of the world, and you are entering new ones now. You are, for example, entering Asia and entering Latin America. In your view, how difficult it is to adapt to new countries? For example, now that you are entering the Americas, so what percentage of what you have is standard for every country, and what percentage you have to customize for each different country you are entering now?
Yeah, no, thanks. Very, very relevant question. I guess it's difficult. Like every country is different, especially when you move outside of Europe. So what we generally do, we look for a partner on the ground that knows the market and can help us to understand what are the best public and private sources of data we can use. And then we try to keep about 70% of our infrastructure as is and adapt the remaining 30%. It's generally the alternative data really the one that needs to change quite a lot.